Hi everyone, so today we will be looking into new IFRS that will discuss about revenue recognition. So basically in this IFRS we will learn on how we are going to recognize revenue. Is it right after we have delivered the goods to the customer, or in terms of services, when should we recognize the revenue as part of our income? So basically at the end of this chapter you should be able to learn on three different things. First is you should be able to explain the importance of guidance on revenue recognition, why revenue recognition is so important. Secondly, explain this new revenue standard. So IFRS 15 is a new standard. And lastly, discuss any issues that are related to revenue recognition. So this is one example of revenue recognition. So let's say you are in this situation whereby you have paid for your gym membership on the 1st of January and you have paid an annual fee of £350. The gym has a financial year end 31st March. So the question is, how much revenue that this gym should recognize at the end of 31st March for this particular year? So basically, I believe that this one is quite simple for you all. So this one is related to prepayment, accruals and things like that. So you have paid 350 for 12 months from 1st January to December. Okay, but this gym have financial year end on the 31st March. So of course, based on this question, we know that we have prepayment or deferred income. So how do we know how much that we should include in our income statement as of 31st March for this year? So it's very easy. What you have to do is you take this £350, you times with 12 and times with 3 months in order to know how much income that you should recognize for this financial year end. So basically, this would be the general entry that you have to make for this year ended 31st March. You have to recognize income or cash receipt. You have to recognize cash receipt of 350, and then you can recognize revenue for the first 3 months, which is from January to March. So in your income statement, you will see this amount, £87.50p, and the balance would be included as part of your deferred income. So if you want to know further what is deferred income, you can look at the deferred tax video whereby I explain what is this deferred income. So deferred income, please remember, this one is basically like a prepaid revenue. So prepaid revenue is considered as our liability. So it's a prepaid revenue. So this is the liability that we have to recognize in our balance sheet. So this one you will include in your balance sheet, and this amount you will include in your P&L. Right? So basically it's not that complicated, not that difficult, because this scenario there is only one performance obligation whereby, so it's not that difficult. Why? Because this gym can just recognize revenue based on the service that they have provided to you. Alright, now with this new standard IFRS 15, so this IFRS 15 has actually explained that there are 5 steps that we have to go through in order to recognize the revenue. So what are the 5 steps? So step number 1 is for you to identify the contract. It can be a written contract, it can be an oral contract, as long as there is an agreement between two parties that enforce rights and obligation. Okay, for example, like you go to the supermarket, you take whatever things that you need and then you pay at the cashier. So by the time you take the items from the shelf, it's considered as a contract already, whereby you agree to accept those goods, and when you go to the cashier, you make the payment so that things become yours. Okay, so first is there must be a contract. So it can be a formally written contract or it can be just an oral contract. Secondly is you have to identify performance obligation within a contract. So in certain transaction, there can be more than one performance obligation. So what is actually performance obligation? So the simplest example that I can give you is, let's say you buy a laptop, okay? So when you buy a laptop, let's say the laptop costs you around 2,000 ringgit. And then apart from that laptop, you also buy a extended warranty for 2 years. Okay, so in that case, there are two types of performance obligation. The first one is the sale of the laptop. Okay, you buy the laptop, and then secondly is the sale of the warranty. So in that case, there are two different types of performance obligation. All right. Thirdly is for you to determine the transaction price. So how much is the price that you have to pay in order in order to be entitled in exchange for the transferring promised goods or services to a customer. So how much that you have to pay in order to be the owner of that goods. Number 4, you have to allocate the transaction price to the performance obligation. So total price should be allocated to the elements of the contract in proportion to the stand-alone prices. So we will look into the example later on. What does this step number 4 means? So it's basically from this transaction price, you have to decide what would be the price to be allocated for each of the performance obligation. You will understand it better when we look into the example. And the last step is for you to recognize the revenue. Okay, meaning that include that as part of your financial statement. Alright, so these are the 5 steps that we have to go through in order to record a revenue. Alright, so when we talk about application of the IFRS 15, it applies in different area. Okay, the most common one is through sales of goods. So after you sell your goods to your customers, once it has been delivered and received by your customers, you can recognize that as part of your revenue already. So the main issues is for services. When should you recognize revenue? Let's say you are delivering service. You are not selling tangible goods or products, but you are selling service. So when should you recognize that service? So that is the issue that is covered in this IFRS 15. Alright. Thirdly is, let's say you are an agent. Let's say you are you are working with a travel agency, and as the agent, you will receive income based on the commission paid. Alright. So in that case, how are you going to recognize the commission that you have received? By selling a particular travel package. Okay, it could be in terms of warranties as well. So let's say if you buy gadgets, normally it comes with a warranty. So now you can even buy an extended warranty to cover additional 2 or 3 years. So that is also considered as an income for that company. So how that company recognize warranty as part of their income? So it is also covered in IFRS 15 and also long-term contract. So best example of long-term contract is, for example, like a construction. Okay, so I have always given this example in class. So if let's say you are a construction company, how do you recognize revenue? It based on the percentage of work done. It is not based on the time or the period in which the contract has undergone, but it is based on the period. It is based on the work done. What is the percentage of work done? Is it 30%, 50%? You will recognize revenue based on that. Alright, now let's look at into the example. So this is quite simple. So let's read the example together. So on the 1st November, Arya sells a computer with a 24 months technical support package for 1,000 £8,000. So if you can see here, Aria is a company selling computer. Apart from computer, they are also selling 24 months technical support for £1,000. So meaning that you buy a computer together with this 24 months technical support, you have to pay for £1,000. Okay, so the standalone cost of the computer is usually £800, and the technical support could be purchased off the shelf at a total cost of $450 for 2 years. So let's say you do not want to buy this package, okay, you can just buy the laptop or the computer. You can just pay 800 ringgit for the computer, £800 for the computer. And let's say if you want to buy technical support for 2 years separately, so you have to pay £450. So this is the standalone cost. Then standalone meaning that you buy these two things separately. It is not part of a package. Okay. At 1st November 2005, legal title of the computer passes to the customer. So as soon as the customer pay this package, so the laptop or the computer already belongs to the customer. So meaning that ownership has been transferred to the customer when the customer make the payment. So required here, you are required to advise Aria on how to account for this transaction for the period 30th November 2005. So how Aria is going to recognize this transaction. So as I have explained, there are 5 steps that we have to go through. So let's go through the 5 steps one by one. So what is the first step just now? So the first step is you have to identify the contract. Is there any contract? Yes. It is a contract between Aria and also the customer. What contract is this? The contract is about the selling of the computer and also the technical service. So this customer bought this package. So how much this customer has to pay? He or she has to pay for £1,000. So there is a contract in this case. So the second step is you have to recognize what is the performance obligation in this question. There are 2 performance obligation. The first one is you have to sell the computer and also you have to provide 24 months technical service. So you are selling 2 different things. First, you are selling the computer. You are also selling the 2 years technical service. What is the next step? The next step is for you to recognize how much that the customer has to pay. Like I said just now, this customer bought this package and he only have to pay £1,000. If he decide to buy separately, the computer will cost him, the computer alone will cost him £800, and the technical support alone is for £450. So let's say if the customer decide to buy separately, the total that he have to pay is 1,250. But now this customer is buying the package, so he only have to pay £1,000 instead of 1,250. So 1,250 is the cost if the customer decide to bought this computer and also technical service separately. Alright, step number 4. Step number 4 is you have to allocate the transaction price to the performance obligation in this contract. So this one is related to number 2 and number 3. Okay, what does it mean here? Alright, so this customer have to pay £1,000. So this £1,000 is the transaction price. Okay, so this customer is buying the computer as well as the technical service as one package. So that's why he only have to pay £1,000. If let's say he didn't buy this package, he bought the computer and the technical service separately, he would have to pay £800 for the computer, and the total for computer plus the technical support will cost him 1250. So you have to allocate this. So if you allocate this, £1,000 is the price that the customer pay, times 800 over 1250, meaning that the transaction price that is allocated in the first performance obligation, this is performance obligation number 1, is 640. So instead of paying £800 for the computer, now this customer only have to pay 640 for the computer because of this package. Alright. The second performance obligation is related to the technical support as included in this package. Okay. So this technical support, how much is the transaction price allocated for this support? You take the transaction price times with the 450. 450 is the original price if the customer decide to buy this technical support separately. And the total cost is 1250. So from this £1,000, 360 is actually for technical support. So again, the customer has to pay lower as compared to the original price. Original price is 450, but because he or she is buying in this contract, in this based on this package, so now he only have to pay £360. Okay, it's a saving for the customer. Alright, what is the last step? So last step is the very important step, but in this step, you have to recognize the revenue. You have to decide what to debit and what to credit. So in this case, there are two things: the purchase of the computer and also the purchase of the technical support. So how do we recognize this income? Alright, so the sale of computer is 640 based on this one, based on number 4 here. So 640 to be recognized immediately as part of the revenue. Next is we have to recognize income of £15 from this technical support. So from number 4 here, we know that 360 is the income that we get from selling the technical support, but 360 here is for 24 months. Okay, this customer bought this item on the 1st November, so meaning that only 1 month. We can only recognize income from technical support for 1 month, so meaning that you only have to recognize £15. So overall, how do you record this? Okay, so another 360 minus 15, meaning that there is still £345 that is not recognized. Another £345 will be included as part of your deferred income. Okay, remember what is a deferred income? It's a prepayment, prepaid revenue, income that you receive in advance. So when we receive income in advance, it is our liability. So remember, this is a 24 months, which is equal to 2 years technical support. So for the next 12 months, you are expected to recognize another 180. So in this case, this 180, you have to record as part of your current liability and under the deferred income account, and then another 165 that you will recognize in the second year will be included as part of your non-current liability. So what is the journal entry for this? This would be the journal entry for 30th November 2005. So you receive cash from the customer, 1,000 ringgit. Okay. This one is the cash that you receive by selling the computer plus the technical support. And then you have to credit revenue, 655. 655 here is 640. The revenue from the computer and £15 from the technical support. And the balance will be recorded in the deferred liability account. So revenue that you will recognize in the next 12 months, which is this one, will be included as part of your current liability, whereby this one is next year. You will recognize this next year in the next 12 months. So in that case, you have to recognize as current liability. And this one, you have to recognize under non-current liability, the balance that you will recognize in the second year. Okay, so this is how you actually recognize revenue. Okay, so we have to follow this step number 1 to step number 5. So, alright, we recap again. Number 1 is you have to identify if there is any contract. In this question, of course, there is a contract between Arya and the customer. Secondly is you have to recognize what are the performance obligation that we have. The performance obligation is there are two. We have to sell the computer to the customer, and we also have to provide 24 months technical service. So this is the service that we are selling. This is the product. Third step is you have to recognize the transaction price. So meaning that what is the price that the customer has to pay in order to transfer the ownership from the seller to the buyer. So in this question, the customer have to pay £1,000 for the computer plus the technical service. So if the customer decide to bought these two things separately, so he or she has to pay higher. He has to pay £800 for the computer alone and another 450 for technical support. So this 800 and 450 pound helps you to do number 4. In number 4, you have to allocate the transaction price to the performance obligation. So in step number 4 here, you have to relate step number 2 and step number 3. Okay. So there are two performance obligation, the computer and also the technical support. So the transaction price is 1,000. So you have to times with the cost of the computer, original cost of the computer, divide by the total original cost of both performance obligation. So in this case, 640 is the amount that the customer have to pay for the computer, and 360 is the amount that the customer has to pay for the technical support. Alright, in step number 5, you have to recognize how much is the income that we should include in the 30th November 2005. So based on our calculation here, we know that this company Arya can recognize revenue of 655 and the balance will remain in the deferred liability account. So 180 will be recognized in the next 12 months, so it is classified under current liability. The balance of 165 will only be recognized after that 12 months. Take more than 12 months for you to recognize, so it is part of your non-current liability. Alright, so these are the steps that we have to follow in order to recognize revenue in our financial reports. Alright. So that the first example is about the selling of product and also services. The product is computer. Service that we provide is a technical support. So let's look at into the second example. So in this example, the only difference is in terms of the performance obligation. So in the first example just now, we see that there are two performance obligation whereby the seller have to sell the computer. And the second performance obligation is the seller has to give technical support to the customer for 2 years. Alright, so in this second example, you will see that there is only one performance obligation. So let's read through the question first. So on the 1st September, Jensen received total subscriptions in advance of £240,000. So the subscriptions are for 24 monthly publications of a magazine produced by Jensen PLC. At the year end, Janssen has produced and dispatched 6 of the 24 publication. The total cost is estimated to be £192, with each publication costing a broadly similar amount. Alright, so in this question, so this is a magazine company. Janssen is a magazine company producing magazine and delivered it to the subscribers. So for this financial year, on the 1st September, so they have received subscription of £240,000 in advance. So this is a prepaid revenue. So this subscription is for 24 monthly publication of a magazine produced by Janssen. So 24 meaning that it is for 2 years. The subscription that you receive in advance here is for 2 years. So as at financial year 31st March 2001, Janssen has produced and dispatched 6 of the 24 publication, and the total cost to produce all 24 magazine is £192,000. Alright, what we have to do here, you are required to advise Janssen how we account for this transaction for the financial year 31st March 2001. So the same like example number 1 just now, you have to follow step number 1 to step number 5. So step number 1 is for you to identify if there is any contract. So of course there is a contract between this company and also the subscribers. What is the contract about? The contract is about producing and delivering 24 months publication. Alright, so that is the contract. So the next one is you have to identify the performance obligation. So based on this question, we understand that there is only one performance obligation, whereby you have to produce and dispatch the magazines to the subscribers for 2 years period. Only one performance obligation. So what is the transaction price? You receive £240,000 in advance. So this £240,000 is for 24 publication. Okay, so the total revenue that you get is £240,000. So this one is a prepaid income, yeah, deferred income. Number 4, you have to allocate the transaction price to the performance obligation in the contract. So there is only one performance obligation. The transaction price is £240,000. So the profit that you earn for every publication is £2,000. So this is the income that you get for the 24 publications. Total cost that you have to incur is £192,000 as indicated in the question, divided by 24 months. So the income that you get for each publication is £2,000. So the last step is for you to recognize the revenue. So in this case, as of 31st March 2001, as in the question just now, it says that for until this period, we have delivered 6 magazines. So can you recognize all 240,000 as your income? No, that's wrong. You have to times 6. So £240,000 is for 24 months times 6, meaning that you can only recognize revenue of £60,000. Okay. The cost that you incur to produce these 6 magazines is £48,000. So for these two figures will have to be recognized immediately in your P&L. Alright, so how much is the deferred income that you receive? In this case, you receive a deferred income of £180,000, of which £120,000 will be recognized in the next 12 months. So this will be part of your current liability. And also, the balance of £60 will be part of your non-current liability. So how do you do the journal entry on the 31st March 2001? So this would be the journal entry. So debit cash. So you receive cash of £240,000, the total cash. but you can only recognize 60,000 as part of your revenue for this 31st March 2001. And then these two, the balance is your deferred liability or your deferred income, whereby you have to recognize as part of your current liability. This one is for the next 12 months, and the balance is in your non-current liability. Alright, so this is how we recognize revenue based on IFRS 15. So basically you have to follow the steps, the 5 steps. It looks simple, but the question can be quite tricky. So you really have to understand what kind of performance obligation that this seller is giving, what is the transaction cost, and then how do you allocate the transaction cost to the performance obligation. Because if your number 4 is wrong, the figures that you use for the journal entry will be wrong as well. So that's it for this revenue recognition. So I'll see you in the next video, whereby I will discuss on the next topic.